Okay, let's answer some questions from the last market outlook. And this first one will answer a number of questions I got about ChatGPT. And this is just an example that was put up, and then I'll show you some more questions. But I did get a question of several questions behind this. And I have already made the statement that I'm generally unimpressed with it, which I remain unimpressed with it. And you'll see on the next screen that it is rather, I'm sure there are some questions you can ask it where it's an easy search and they can give you an answer and it's impressive, but when it has to think, it's unimpressive. Not a question, but something interesting. I asked ChatGPT this question. Now, if you've studied any logic or probability, you know that A and B is a very specific question, and A or B is a different question altogether. So let me draw a circle of all the things that are true for A. Let me draw a circle of all the things that are true for B. A and B are here. That's a very specific question with a very specific answer. It's the intersection set of two things. So if A is a list of stocks and B is a list of stocks, A and B are the list of stocks that share the qualities of both A and B. A or B, this is A here, and this is B here, or the intersection. Anything can be true, but this over here, if I put a little check mark over here for this particular asset, that is not the answer to A and B. If JGB, I think you mean Japan because JGB are the bonds. If Japan is buying a lot of bonds to maintain their 10-year bond yield at 0.5 and the US dollar is falling, what assets would be a good investment? And the answer always repeats the question. Whatever you type in, it will always repeat the question. If the Bank of Japan is buying a lot of bonds in order to maintain their 10-year, what is nice though is that they did correct the thing, so I think that's kind of nice. Is buying a lot of bonds in order to maintain their 10-year Japanese government bond yield at 0.5 and the US dollar is falling. Now, the answer is B. It could indicate a period of monetary easing and a weak US dollar. Really? The US dollar is falling could indicate a weak US dollar? I mean, okay. Under these conditions, there are a few assets that may be considered good investments. This is the answer to B. The US dollar is falling. The US dollar is falling. The US dollar is falling. It only answered B. It did not answer A and B. Okay, I'll show you a very typical setup of a question in finance. And no, it's not this first question, but this is a very typical setup. Name an item that is the same color as an apple. If you ask a human that, 95% of them will throw an answer out almost right away, and they'll name an item. 5% will say, well, what kind of apple? Because there are red apples, green apples, yellow apples, gold apples, white apples. What kind of apple are you talking about? Because in my mind, I might have a Granny Smith apple and waiting for you to say leaf or grass, but then you say fire truck, and I say, oh, you made the assumption that it was red. I was making the assumption that it was green. 5% of you might have said, well, hang on here, there's a hidden assumption. We must surface this hidden assumption so that we have precision in our answer. And then you would be in a position to answer. There's ChatGPT's answer. A red apple is an item that is the same color as an apple. Well, that's not really the answer, is it? That's not really what I was asking for, was it? And you made the assumption that the apple was red. You did not uncover the hidden assumptions. In finance, that's deadly. If you're going to ask it a question and it gives you an answer and you make an investment on that answer, you don't know what hidden assumptions are in there. When you are using ChatGPT, if you're assessing it, you have to interrogate it and you have to follow the rules of interrogation. So how it normally works is, let's say that you get arrested for a crime and brought into a little room, and you agree to testify against somebody bigger because they're going after somebody bigger in exchange for immunity. That's not the end of it. You don't get a yes right away. You get a whole bunch of questions thrown at you because the interrogators have to know whether or not you're going to give honest answers. So the first 10 or 15 questions they ask you, or maybe even 20, are questions they already know the answer to. They want to know if you're going to be truthful. So they'll slide a picture across the table and say, Who's this person right here? Well, they already know the answer to it. They want to know if you're going to be truthful. They have to baseline you first and develop trust. Once they are done asking you all the questions that they know the answers to, then they can begin to ask you questions they don't know the answer to. And if you lie in the first little while that they're interrogating you, that's the end of it. You're not getting immunity. You're being charged because they can't trust you. And if you think you can play them by saying, I know what you're doing, the first 10 or 15 questions you already know the answer to, I'll start lying later on. Well, you don't know when they're going to switch from answers they know to answers they don't. And you don't know if it's going to be a couple answers they know, a couple answers they don't, a couple answers they know, a couple answers they don't. So you pretty much have to tell the truth because there are traps everywhere. If you're going to trust the answers for ChatGPT, you must ask it a series of questions that you already know the answer to so you can assess whether or not you trust its answers. Do you trust it based on this question and answer? I wouldn't trust it, not with my money, not if I'm making a real bet. What if I asked it a question like this that I can ask an analyst? Name an asset that is negatively correlated with fiscal policy. So I can ask an analyst that, and an analyst would if that is their field, they would be able to come up with a whole bunch of assets. A good analyst would ask follow-on clarifying questions. Well, what aspect of fiscal policy do you mean? What specifically do you have in mind when you're talking about fiscal policy? Are you talking about gridlock? Are you talking about spending? Are you talking about taxation? What part of it? And I'll give you the list of assets that you want. No follow-on questions. It's just error. It just breaks down. So the question was, do you see ChatGPT replacing people in finance, replacing jobs, replacing charter holders? Is it still worth getting a charter? Yeah, because it cannot answer these types of questions. Now I can ask it better questions. I can ask it single questions of which I get single answers for, very direct questions. So will it augment what I do? Will it be a useful tool? Sure, but not a replacement. Much like Google has not replaced anybody, but it's a super useful tool. Is upside call just another way of saying at the money call, or there's any difference, or say implied intentions? Yeah, when I say upside call, I typically mean out of the money, meaning that it's to the upside of wherever the price is. Sometimes I say in front of the market or behind the market. So in front of the market means out of the money. A call above where the price is, that's in front of the market. Behind the market would mean an in the money call. So sometimes I say, upside, downside, in front, behind. It's just the terminology that I've developed in my head that to me makes sense. And sometimes I should be more clear by using the actual terms in the money, out of the money, at the money. So good point. I don't know if you follow Barry Knapp. No, don't know who it is or not, but he had a recent podcast on the Contrarian Investor podcast that incredibly curious your opinion on. He believes the U.S. is going to have a significant spending revamping in infrastructure. Well, it needs it, that's for sure. And capital stock. That's interesting. He incredibly bullish on industrials and materials, which at least seems to be in line with your investments in PIC. My investment or my choice of the miners and being where the miners are is because of the electrification of the grid and just the sheer amount of copper and other materials you need to get that done. Moving cars all to electric is just the battery material alone. And the amount of copper within an electric car is significantly more than what's in an internal combustion vehicle. Cat's outlook was very bullish. Each one of those big, heavy moving pieces of equipment is something like 250 pounds of copper in every single one of them. So I'm bullish because of that. I think this would be a problem if there is a significant spending in infrastructure and capital stock. I think you would hit inflationary pressures very soon. So I'm not really sure that can get done. Also, I would not look for any grand bargain in Congress anytime soon. I would look for just death and destruction really, because you're going to have some people who McCarthy's just not going to be able to put anything on the floor for a vote. It's not going to happen. It's just a shit show out there. So this would be a beneficial thing if it weren't for the lack of employment or the lack of workers out there to get all this stuff done. If it weren't for the elevated prices that would have to be paid on this, and for the fact that it's never, ever, ever going to see the light of day out of Congress for the next 2 years. So I don't quite agree that it's going to happen. Do you like Aussie miners over U.S. denominated ones? I didn't pick miners based on nationality of their home office. I picked it based on best in class. Who are the biggest, most global ones? And they just happen to be Aussie ones. So that's why I ended there. Okay, can someone improve my understanding of the Japan situation? Investors are pushing up yields on JGB because BOJ isn't raising rates as much as other countries are, pushing the yields above the BOJ's cap. What is the reasoning for the 0.5 cap? Well, inflation is moving up. So you, on the 10-year, you are facing a very negative real yield. You're pushing up to about 4%. We're going to get CPI numbers from Japan this week, and we're going to see what that number is. And if it comes in hot, well, then, why would you hold on to a bond? It's not that investors are pushing up the yield. It's investors are saying, look, enough. If all you're going to give me is 0.5% on a 10-year with inflation moving up and my real yield dropping, I'm gone. So they're just selling the bonds. Now, there may be some active short selling of the bonds because the carry on the short position is really cheap, 0.5 yield, but the upside could be huge if they forego the cap. So if this week we have the BOJ, I'm doing this Tuesday, it's 4:56 my time, 5 o'clock. In 5 hours, the BOJ makes an announcement. If in that announcement they decide to abandon yield curve control, they're not gonna raise rates. If they abandon yield curve control, if that's their first step, then that yield will rise very, very quickly. They have a significant amount of government debt, the highest in the world, However, it's primarily held by their own citizens. The danger is if their own citizens are dumping the bonds for other bonds, then the central bank is going to have to buy up all those bonds. And if for fiscal policy they need to issue more bonds, if the yield isn't there, you basically have a system where the central bank is going to have to continually just print the money that the government needs to spend. They have, I think, one of the oldest populations out there, so I imagine that the entitlement payments must be huge, because I don't think that they have enough people in the workforce right now to fund all of the pensions that are given within that particular country. I don't know enough about Japan to really square that, to go into detail about it. But if you just sit back and think about that, that really an aging population, they've had deflation and disinflation for the longest time. They've been trying to get inflation, heck, now for 30 years they've been trying to get inflation, and it's finally showing up. And the big issue, I think, for the next little while is you have an outgoing Bank of Japan governor, and usually it is fairly well established that the outgoing governor does not make significant any changes really in monetary policy that the next one has to live with. It usually just sits on hold for another month until the new one comes in. Then the new one institutes a monetary policy regime that they themselves care to oversee for the next how many years. But yield curve control, they may do something there because it's breached that cap again today. What are your thoughts on the Fed once again changing how it calculates CPI? Well, here I have to ask a clarifying question. It is the BLS that calculates CPI. It's not the Fed that calculates CPI. And CPI the calculation does have changes quite frequently. Every year there's a change in some category somewhere. So this is it's quite common. It's not anything that we should clutch our pearls over and go, oh, they're trying to get one over on us. This happens a lot. Now, if you mean when we're talking about the Fed not changing how it calculates, but paying attention to a different calculation of CPI, they used to pay attention to core PCE. And they decided that, well, core PCE, never mind about that because there's no inflation really in goods. Let's just pay attention to services, the services component. And since we know housing works with a lag, and we can clearly see that housing prices are coming down and rents have started to roll over, rents month over month are starting to print negative, why don't we look at services X housing? What they're trying to get to is where inflation really lies. They're not trying to make it go away. It's almost as if they're trying to make it stay. They're weeding out the last possible corners that inflation could be hiding in. They know it's not in goods, so let's not pay attention to goods because goods could distort the number to the downside. We know it's not in housing because housing is lagging, and we know it's going to fall off over time, so let's just ignore that. Let's see if it's left in services. They're basically hunting it out until it has no place left to hide. That's when they'll start cutting rates. If everyone expects a crash, do we get a contrarian soft landing or do we get something even worse? Well, when we're talking about the expectations, we're talking really about investor sentiment. And investor sentiment, if you take the investor sentiment survey, and we'll call that Y, and you regress it onto real GDP, and that is our independent variable. The beta here is not significant. Beta is no different than zero. In other words, investor sentiment has nothing to do with real GDP. So we cannot say everyone's expecting a crash, we're going to get a soft landing in the economy. So you can't go from investor sentiment to the real economy. However, you can go from the credit market to the real economy. If sentiment in the credit market is negative, which causes lenders to pull back, it does have a correlation with real GDP. So it's not that we're concerned about equity investors. Screw them. They're always wrong anyways. Bond investors are considered the smart money. So let's pay attention to what they have to say. And if their sentiment is negative in those markets, then that can cause a decline in real GDP. But when we look at the OAS, they're not expanding, they're actually tightening, indicating that creditor sentiment is quite buoyant. You said pricing 50 basis point rate cut is not reasonable because we will have either soft landing and no or slow cuts or recession and higher cuts. Isn't 50 basis points a middle point and expected value weighted by possibilities of recession, soft landing being perceived as 50-50 now? Yeah, you could say that. Usually when we look at a number from the market, we usually refer to that as, the market is pricing in this 50 basis points, or they call it the consensus view. In this interpretation, if we think about it as a weighted average of those who say no, it's going to stay at 5 for December versus those that say we're going to have a recession and it's 2.5 by December, if we're at 4.46, it does show some weighting of probabilities on those two. That if we infer the probabilities of that, then we can see what the lack of consensus is. So maybe 4.46 is better referred to as the lack of consensus number if we think there are only two extremes as opposed to a consensus, because I don't see that there'll be 50. So let's see, 2 questions here. Some industry experts I talked to last week argue that EPS growth in 2023 will come mainly from the reopening in China. As consumer savings increased over the last 2 years, which they likely spent in 2023, as we have seen in the U.S. and Europe in 2021 after the economy reopened. What's your view on that? Well, I think we're making the assumption that the consumer culture in China is the same as what we would see in U.S. and Europe. We're also making the assumption that China is enough to result in EPS growth, as opposed to Europe and the U.S., which would, by all consensus, we are looking at lower, in other words, negative growth, and that China would be enough to not only overcome the negative growth but add to positive growth. When the lockdowns ended, you had a bunch of people who said, let us out, let us out. And there was these lockdowns. They said, okay, out you go. COVID spread all over the place, and these guys went back inside and said, no, you know what? We're good in here. We're good in here. And no one actually, all the people who wanted to be let out didn't actually go out. And China reported for a while deaths that were like 8, this week, 14 that week. And they got really criticized for it. So they actually started publishing numbers. The last number they came out with was 60,000 had died in a very short period of time. I think that was a week, or that's since the beginning of the year. I'm not really sure. That in itself is keeping enough people inside. So, yeah, there's an argument to be said that when you keep people locked up for a period of time, all that money builds up, and then they're going to go out and spend it somewhere. But wouldn't that just push recession back over the edge again? Second largest economy, everybody locked up, heading out. It's not like the U.S. It's, bigger. If we think that they have the same amount of consumers, because not everybody in China has money, if they have the same amount of consumers, would that not just cause the same thing to happen all over again? I don't know. I don't know if they're really consumption oriented like US and Europe are. When North America went into lockdown, all of that money went into goods, ordering online, and all of the goods orders, because there were no services to buy, so all the money went into goods. When China was locked down, I don't know that you saw that. Did a lot of money go into goods? And if it didn't, if that wasn't happening while they were locked down, that would say that they don't have the same marginal propensity to consume as US and Europe. I don't know the numbers for it, but I'm going to go ahead and guess that the country in aggregate has a significantly lower propensity to consume than the US does. So I don't know that I would really run with that one. If you have a bull case and it's just one of the bullet points on the bull case, you can say, well, yeah, I don't know that it's going to be a negative. If you think about it net, it's not a net negative. It may be a net positive, but EPS growth will come mainly from China is a big, bold statement. It's an investment thesis on its own. I don't know that I would elevate it to the level of an investment thesis. I think it probably sits very well as a bullet point on a list of bullet points to be bullish about. As there is a risk of a price war in the automotive industry, and we see it in China, XPeng dropped the price of its vehicles as well. And BMW in that country, or was it BMW or Mercedes? I forget which one, but they dropped their price as well. There's a full-out EV war going on in China right now. Do you have an opinion about shorting the German index, considering that the index includes all major German car manufacturers and many industrial companies relying heavily on gas? No, I don't think I would do that at all. No, I don't think I would go there. Which they won't get as cheap as they did from Russia pre-war. The index currently trades around 12x forward earnings, which are around 10-year average. 2023 EPS only slightly below 2022 levels. Listen, these price wars, they never last long. They never last long because it is sort of a game of who can hold their breath the longest, who can hold out the longest while their cash flow dwindles away. And that's what's going to happen because you have super margin compression and you're willing to sacrifice your margin for market share, because if one company in a competitive market lowers prices below yours, they're going to hurt. But if you don't lower them, that's not the best reaction to what they're doing, because they're going to gain market share. And they will take sales away from you, in which case you'll have lower revenues and lower EPS, even though you've saved your margin. So it's sort of the prisoner's dilemma, if you think of game theory, right? That if everyone is better off if nobody engages in a price war. But if your competitor engages in a price war, you are at a disadvantage if you do not match them. So everyone engages in a price war, which is the rational thing to do if there's a price war, because otherwise you would suffer, but it's a suboptimal equilibrium in that particular market because everybody suffers in a price war, and it never lasts long, especially in an asset-intensive industry like automotive. It does a lot of damage to a lot of investors. It does a lot of damage to a lot of equity and market value, but it's a big benefit for consumers. When companies get into price wars. It's a major benefit for consumers. Up to a point. If a price war persists long enough, companies then start to swap out cheaper parts. And they try to cheapen the car as much as possible. Maybe they make the frame a little bit thinner. Maybe they make, they try to find a way to eliminate parts, to use cheaper parts instead of the better parts. So there comes a point where a price war will actually start to diminish the very quality of the car that you're buying, and now everybody's making shitty cars because everyone's in a price war that nobody can win. And the best way to stop a price war is if everyone just stops right away. However, here's the thing. You cannot collude. You can't call your competition and say, look, no one's winning with this. No one's winning. We're all losing. We'll all be out of business in no time. Let's just stop. That's collusion now. That's price fixing. That's illegal. So you have to have a very game theoretic perspective where you have an implicit understanding that if I stop, my competitor may also stop and say, oh, thank God it's over. But I wasn't going to blink first. So how do you communicate to your competitor that we should stop this price war without actually communicating that you should stop this price war? How do you stop a price war without breaking the law? That's a difficult thing to do. The price war is happening in a new market for vehicles. China is a relatively new market for vehicles. The majors, the traditional automakers that were engaged in price wars in the 70s and 80s. And the 80s, first part of the 80s was the worst time to buy a car because cars were built with something called planned obsolescence. They were meant to last 4 or 5 years because that's the only way you could make money in a price war. Chrysler was on the brink of bankruptcy. Lee Iacocca had to go to Washington and ask for a bailout. And the cars sucked, and that's how Toyota became dominant in the US because they made a good quality car, while everybody else made absolute garbage because of that price war. Toyota just made a smaller car, so they didn't have to compete on price because a smaller car was cheaper to begin with. So they learned their lesson that nobody wins in a price war. That's why they don't engage in price wars anymore. But this is a new market. Will the price war spill over from China to the rest of the world? That's an interesting question. Will the companies who started the price war be able to continue to invest and grow, being that they're actually sacrificing their cash flow river at this point? That's another interesting question as well. But it does make the industry unattractive at the margin because this is going on. So, if GM goes, it's at 36 and change today, it's holding up fairly well. But if I see it drop to 34, 33, 32, I will not be as eager to jump in on it at that point until I see more clarity on what the spillover of this price war would be. And it doesn't take 2-3 quarters to figure out what's going to happen. The responses are usually week after week after week. That if GM and Ford are going to get involved in the price war, you're going to hear about a price slash on the Bolt. You're going to hear about a price slash on maybe the probably not the F-150 because there is no other truck out there, but maybe the Mustang. You'll start to hear price cuts on other vehicles in other markets. If that happens, that's a slippery slope that you don't want to be on. I'm trying to remember your comments about the crypto and what the decentralized blockchain is fixing as a real problem in the real world. I know it's nothing, but it's more the explanation I'm interested in. It was in which week again? So what I said about this is that, it presents itself as a solution to a problem that doesn't exist. I don't have any particular problem in my life that I think, what could really fix this is a decentralized database with nobody in charge. I don't have I want somebody in charge. I hear this commercial on Bloomberg. It's Matt Levine. I think he's pushing his book, The Crypto Story, and he's talking about, modern life is made up of entries in databases. And he says if you have a bank statement, what you have are entries in databases. And then he says, somebody controls that database. And he says, well, imagine if nobody controlled it and you only had one. He said that would be like having one database. And then he moves, and from that he goes, well, whoever controlled that one database. Well, hang on a second. You've gone from decentralized to imagining a centralized to imagining one single person controlling it, and then you're telling us we should be scared of it, because in that he says that would be scary. Well, that's the crypto story. That's what you have to do to sell crypto, is you have to scare people, you have to create something that doesn't exist, you have to tell them there's this future out there where somebody is going to control your data. Think about that for a second. Control my data? Who controls my data? Nobody controls. I control my data. My data is just a result of my actions, and I control my actions. I don't have to buy on Amazon. I don't have to surf the internet. I don't have to look up stuff that if anybody found out, I'd be a little bit embarrassed. I don't have to do any. I control my own data. You may collect certain aspects of my data about me, but you don't control my data. So the idea of this idea controlling your data, people saying, I don't want anybody knowing this about me. So let me ask you this. What if somebody knew where you lived? What if somebody knew what kind of cars you drive? What if they knew the license plate numbers of those cars? What if they knew what your kids look like? What if they know what school your kids went to, what time your kids went home at? What if they knew your wife's name, what she looked like, what you look like, what your kids look like? How would you feel if somebody had all that information? Well, let me tell you about neighbors, because they have all that information. Well, you want to put them on the blockchain? I mean, come on. Like, when we think about it. By the way, I want you to think about this for a minute. If you think about Bitcoin and the blockchain for Bitcoin, it's very specific. Okay, there are different blockchains that do different things. Bitcoin really is for just if you're just transferring Bitcoin between people for just that kind of transaction thing, and it's not really big on transaction stuff at all because of the limitation of how it verifies things. It's based on something called proof of work, which is hugely energy inefficient. The Ethereum blockchain is based on proof of stake, which is super efficient in terms of processing and energy. So it is set up more for higher volume of activity on that blockchain than Bitcoin. But Bitcoin was the original. And it was a paper written by, I'm trying to think of the name, Satoshi Nakamoto, something like that, who is not a real person. The person never exists. You have to ask, after all these years that this person has not been found or never come forward or given themselves away at any point in time. So it is developed by an organization, not an individual, who for good reasons cannot say that they did it, otherwise it wouldn't be accepted. So my theory is that it was either North Korea or a criminal organization like the Triad or the Yakuza. Maybe I watch too much TV and there's no such thing as that, but by some criminal organization or by North Korea or some other organization or entity that needs to operate outside of the system, but yet in plain sight. Untraceable, outside the system but in plain sight. So the idea that somebody somewhere wrote this paper and that nobody's ever been able to figure out who it is and no one's ever stepped forward or even let something slip while they're drinking sake. I say sake because it's a Japanese name and I figure he's out somewhere. He's got to go out sometime and drink. Say, you know what, that blockchain thing, that was me. That's never happened. Like somebody can be that tight-lipped? No. It's an organization. The blockchain on Bitcoin is, if you had to design something for criminal activity, you couldn't do better. It is a gift to criminals. But it solves no real problem. Listen, let's say that you're a bank and you think, hey, this centralized database business, there's really something there. Right? So why do you need Why do you need anybody else involved? Why can't you just have a whole bunch of computers in a whole bunch of different parts of the world? And why do you need everybody else verifying the transactions? Why can't you verify all the transactions yourself? I just don't understand why you need a distributed database. The big reason is, well, anonymity. Well, why do you need anonymity? Right away, that raises the question of, what are you hiding? You must be hiding something. Now, there are some people in some countries that have legitimate reasons for wanting to get their money out of the country. I got to get out of the country. I'm never going to be able to cross the border with any of the valuables or any of the wealth I have. I got to get it out somehow. Maybe this is the way that I'll do it. But that is too small of a use case to result in an industry with everyone chasing the crypto. I think it is a big pile of nothing. A big, big pile of nothing. It is a solution to a problem that nobody has, except criminals. Can you explain how the market drives par rates? I learned from textbook that par rates derive solely from spot rates. Spot rates derived solely from par rates. I guess the question is, how does the market drive the spot rate? So think about a 2-year, a 3-year, 5, 7, 10, 20, 30, and every day there's buying and selling. So there's buying and selling on the 10-year, and it ends there. The price. This is the yield based on the price. There's buying and selling on this one. It ends there. Buying and selling on this one. So market participants are buying and selling bonds, and that buying and selling pressure will push the price up or down, and the yields will move up or down. So we then take all of the bonds in and around the 10-year. And every day they'll extrapolate based on all the bonds lying around the 10-year, some linear extrapolation of all those particular bonds in there, what the 10-year yield would happen to be that would create a par bond. That's how par rates move during the course of the day, is because bonds are traded. So I guess the whole point of this slide is that we have to get a tighter labor market out of our way. But then again, it would need the Fed to induce a recession. To do so by keeping interest rates higher for longer. If that's the case, do you still think bond market has already bottomed, or will it have further downside? When you say bond market has bottomed, we got to be clear here, because there's price and there's yield. When you say the bond market has already bottomed, I think you mean, has the price already bottomed, because that means the yield would go higher. And if that's the case, if you are inducing a recession, the Fed usually cuts rates very quickly. Prices go up because yields go down. So if we think about has the market already bottomed? Yeah. The only condition under which I don't think that you continue to get bond yields higher is you have this kind of thing going on in the market where you have this, there's the economy, low growth for 18 months, 24 months, low growth. Just slightly above zero, but that's a very narrow range to be in for a soft landing, because if this is the zero line and this is 1%, you've got to sort of keep GDP within there, because once you start going this way, it tends to have a self-fulfilling effect on that. You got to keep it within there, because if you go here, you'll start to drive inflation again. Rates will go higher to get this back down. And you need to stay there long enough so that upward sloping supply curve starts doing this. Starts flattening out like this, so that any increase in employment doesn't result in these big jumps in wages, but rather these smaller jumps in wages, smaller increments in wages. You can handle wages going up 2.5%, 3%. That's not inflationary, but 6 to 7% is. Mixed bag. China opening up could also uptick inflation. Okay, I'll put a check on that. That is not incorrect. Additionally, look at services inflation versus goods inflation. U.S. GDP is 70% services, and the BLS is still showing this in services inflation going up, while goods inflation is going down. Curious what your thoughts are on this as it relates to CPI and PCE data. Well, that is sort of where we are right now, and that's why the Fed says it needs to see a sustained pathway down to 2%. And while we've had 3 months of decreasing CPI, we're not at the point where we can say, okay, it's gonna just keep going down, so let's just go ahead and spend money and buy. everything is fixed and everything is solved now. If you get that, you could very well have it resurface again, and in which case it just extends the timeline. But there is some promising data. Canada's core CPI today came in negative 0.3. It's a big drop, and yet the Canadian dollar rallied. If it's negative 0.3, forget about the Bank of Canada moving. The Bank of Canada is probably already done. Why the Canadian dollar would find that a reason to rally? Big head scratch on that one. Just looking at it, going, okay, that doesn't make any sense to me, but very well. Yeah, I think that before I can be bullish on the consumer and spending and say, okay, come on, consumer, let's go, there has to be very strong evidence that there is more supply than demand, or at least more supply capacity that can come online instantly. As opposed to a lack of supply where you're hitting a supply wall with already lowered demand. There I just don't see it happening, and that is the labor market right now. And the labor market right now is everything. You have in the U.S. Population growth that isn't worth talking about. It's so low. You have a participation rate that for the last year really is not going anywhere, and I don't see it going anywhere either. You have an unemployment rate that is at, decades low. You have quit rates over 4 million. People don't quit if they don't think they can find another job. Job openings at 10.5. That's an inflationary fireball waiting to be reignited. So, you've got to be very careful about that. So, as long as we have this kind of environment where, growth is not falling off a cliff, but it's not going anywhere, and the longer we stay in this stale regime, the better it is. Now, there is some thinking that, but why not just raise rates even higher, push the economy into recession, let's just get it over with. Like, really, do we really have to wait another 18 months to 24 months to be in a position where we can say, okay, now we're ready to go? Because if that's the case, earnings are going to do this. They're going to have a slow bleed downwards, which means you're going to have another 1999, 2000, 2001 market where you had a very mild recession, by the way. That was not a big recession. That was a very mild recession. But the markets for 2.5 years went down, 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 down. For 2.5 years went down with a very, very mild recession because you had an environment of just stagnant growth. But it wasn't a deep recession. So this idea that, if we have a recession, it'll be a mild recession, doesn't matter. Doesn't matter if it's a mild recession. What matters is what effect is it going to have on earnings. And if you have a low growth environment for long enough, you will have lower and lower earnings. Reason I say that is because if you have a low growth environment, that means demand is just not there. Companies are going to have a hard time raising prices, which means EPS is going to come from efficiency gains and cutting costs. Well, when you cut costs, jobs are usually the biggest gains that you can make right away. Well, if you cut jobs, suddenly you will get slightly lower growth. Which means you need more efficiency gains or more job cuts, and it's a tighter market, so you can't raise prices even more, which means you need more job cuts. So the longer you stay with benign and very low growth, the more likely it is that you're going to have in the markets this constant slow bleed downward. You don't need a big, ugly recession to cause it. You just need no prospect of growth to then cause companies to say, we got to cut costs if we're going to maintain our EPS. Let's see, in theory, the Fed could potentially achieve a soft landing. So many things can happen in theory. Oh my God, I can't even tell you the things I think about in theory. In theory, 3 women could show up at my door right now and, it would be one hell of a night. In theory. In practice, no. The Fed could potentially achieve a soft landing. What a terrible example. The Fed could potentially achieve a soft landing with a strong labor market. Well, this is interesting already. By gradually raising interest rates to slow down economic growth and curb inflation. Yeah, they could go at 25 basis point moves. And as Kashkari says, to 5.25 to 5.5%, while at the same time implementing policies to support the labor market. The Fed is not a policymaker. They have a mandate, and they have very specific tools. And none of those tools are there to support the labor market. They are not a policymaker. That's Congress. The Fed cannot do that. To support the labor market and maintain low unemployment. Well, that's keeping a tight job market. And if you have a tight job market, any acceleration of growth will immediately cause wage inflation. So, second question, losing interest in auto companies as an income factory. You mentioned GM, but what about Ford? Pretty decent yield, about 4.75%. Yeah, they have a 40%, a 40-cent dividend. Seems to be range bound between 10 and 15. Yeah, I think tighter than that. I think 11 to about upper end of 14 for a while now. Isn't all that bad either. About double out of spot. Yeah, and I have $11 puts and $12 puts that expire this Friday. Ford's sitting somewhere around, I think, $12.50 to $12.60. If it stays above $12 for the next 3 days, then those close without a problem. And I've gone ahead and sold $13. No, what did I sell? $13 calls for February, because I do have a position in Ford. I don't know what earnings are going to look like, and I don't know what guidance is going to look like, and I don't know where that price war is going to spill over to. If it spills over into North America, and if it spills from EV to ICE, I don't know at this point. So, I don't know. I just seem to think that they're just easier fights to win in other parts of the market right now. I think the home builders are probably a good place to be, because I think 10% lower, they're screaming buy. 10% higher, they're screaming sell in this particular market, because I don't see that they're going to go on to all-time new highs in this environment. So I think the big gains in home builders have been done. I think for the next cycle they're going to be winners. I'm still going to own them, but I am going to use calls and puts on them to generate income on them, because they still have decent implied volatility. Just the automakers, I have this scenario in my head that there's going to be, if there's this big price war, there goes earnings for the whole industry. And you could see them, even if they trade down to 5 times earnings, if earnings are nothing, you could see Ford back under $7, $6, $5, GM back down under $20. They've been there before. I really don't want to ride them all the way back down there again. So until I have more clarity, I'd rather just avoid it. The 25th, Tesla reports earnings. We get to see the damage that it caused to the margins. And then you have Ford and GM that are reporting earnings, I think, a couple of weeks after that. I'd rather get clarity out of them and some guidance. They're not going to raise guidance if they think that they're going to be involved in some kind of price war that'll squeeze margins. But I'd like to hear their guidance first, and then okay, I can start using them as an income factory again. But sometimes you have to know when to leave a good relationship before it turns bad. Since the long end of the curve reflects inflation expectations, not only inflation expectations, but growth expectations, couldn't you say that the market believes the Fed is doing its job of lowering inflation, getting inflation back down to 2%? Yeah, that is what is going on the long end of the market. But it doesn't matter if rates are coming down, because that is what's going on. It's a premature cutting of interest rates. It is a loosening of financial conditions, because you have a 10-year yield where you have the market has cut interest rates by 41 basis points this year. Since the start of the year, interest rates have been cut by 41 basis points. So if you are issuing a bond in the market, especially if you're investment grade, and you're issuing a 10-year bond and you're pegged to the 10-year treasury, and you have an OAS above the 10-year treasury, it's pretty cheap debt. Overall, on an after-tax basis, cheaper than equity at this point. That would just spur spending, because a company that issues a bond is going to invest that money in something, and that is demand, right? So that's the problem with premature loosening of financial conditions because it is actually working against the very thing the Fed wants to do. Companies don't borrow money for they don't go to the bond market to borrow money for 3 months or 6 months. They borrow on the longer end of the curve. So, when they look at the market cutting interest rates by 41 basis points since the start of the year, and that OAS is of contracted some 5-6 basis points on investment grade since the beginning of the year. You got a 50 basis point contraction in interest rates at this point. That's the problem. And from SIFMA, I think the data comes as to what the issuance is month to date. And it's on track to be a very good month of issuance simply because of the market having cut rates. If lower capital market yield is partially explained by lower expected inflation going forward, isn't that what the Fed is seeking? No, the Fed is seeking inflation completely out of the system. Lower expected or lower capital market yields is not helping. Why would the Fed wouldn't want the capital market yields to go lower? Because it loosens financial conditions, right? Because if the rate is too low, people won't be compelled to save and will instead spending money, leading to higher inflation. No, it's not that they won't be compelled to save. Most retail investors, when they're saving, are really going to look at the money market, and money market rates are elevated. That's why we have an inverted yield curve. The money market is still very attractive for savers. This is what they do want. They want less spending, more saving. What they don't want is more investment, and cheaper rates will lead to more investment. And more investment means you're buying stuff and you got to spend money, right? This one is rather interesting here. I want you to criticize, comment if possible, on my risk management between taxable and tax-deferred accounts. I have $75K net liquidity in my brokerage account, but say $400K in my IRA. Since I'm only allowed to trade futures in my brokerage account, I sold 2 ES June futures contracts and now have negative DDB around $400K in my taxable account. Looking at brokerage account only, this significantly puts me in a net short position, but I am looking at it holistically, taking into account my tax-deferred accounts as well, which is a total portfolio perspective. When you have investments, you design a portfolio, one of the decisions you make is what's called portfolio location, right? So your portfolio may consist of something that looks like this, where this is your taxable account, this is your tax-deferred account, and as you get older, your tax-deferred account gets better, and this is your tax-free account. And you have a total portfolio. So you may have different asset allocations, equities, REITs, bonds. Then you make the decision of, well, which account will buy which asset. As opposed to treating each account as a separate portfolio, you can take a full portfolio approach. So nothing wrong with doing that. You're hedging out what's in your taxable account. What's in your IRA account. Do you follow the same or similar strategy when it comes to managing risk across types of accounts? Somewhat, yeah. One advantage with this strategy is if we are wrong, we can always use the losses for taxes. This is true, and there is a strategy here of contributing to your IRA or withdrawing from your IRA without penalty. Contributing more than the limit that you have per year. In other words, moving money from your taxable account to your tax-deferred account without a penalty and without actually transferring any money, or when you get close to retirement, draining your taxable account and not having to pay any tax on it as income, but draining it in terms of a capital gain. And it's a little bit tricky, so I will explain it to you because actually, if there's anyone from Revenue Canada listening, if you could just turn off the video and walk away right now, because I don't want you coming up with a law that says I can't do this. Right now, there is no law. But let's say that I have $1 million in my tax-deferred account. Well, that has got to come out, and then you got to pay tax at your regular tax rate. I have a 53% tax rate. That's not going to change by the time I'm 65. And then I have a taxable account. And capital gains in here are taxed at 50% of my normal rate, so they're taxed at 26.5%. How can I get this out of this account and only pay 26.5% on it? I think over the last couple of years, I think if you've been following what I do, I think you see that I'm pretty good at picking things that are winners and pretty good at picking things that are losers. Well, what if I purposely bought losers in this account? You know, you can only take long positions, but what if I purposely bought stock, like when Beyond Meat was $155 and I thought it was a $15 stock? Could I not have bought $1 million of Beyond Meat and purposely brought this account down from $1 million to, well, I mean, it went from 155 to 15. That means it'd be $100,000 left in here because it lost 90%. Can I not bring it down to 100,000 and in this account use a synthetic short on Beyond Meat? So when I closed this synthetic short, I would have made $900,000 over here, but lost $100,000 over here, paid a capital gain here, and now I only have to pay $53,000 in tax, which is a 5.3% tax rate on the $1 million. Could I not just pick winners 5-6 years before I have to take money out of that account and just shrug and say, sorry, Revenue Canada, I made some really shitty decisions in my account? Now, these don't even have to be in the same place. This is with my bank. This is with Interactive Brokers, and they don't talk to each other. Neither one knows what's going on. There's no related party transactions here. So I thought about this for a while, going, what is stopping me from using my expertise? And instead of picking winners, let's pick some real stinkers. Like, for instance, here is a good way for me to drain my account right now. Very, very easy. Bed, Bath, and Beyond is pretty much dead in the water, but it's getting some kind of meme stock rally. Well, why don't I just load up on Bed, Bath, and Beyond and take a synthetic short over here if you can get a synthetic short for any value, right? But if I short it on that side and wait for it to go to zero, transfer all this into this account, I'd have a loss over here of which, by the way, you save money in taxes when you put money in. Now I don't have to pay tax on the way out. And my capital gains tax rate here is 26.5. You can also over contribute early in your career to your TFSA by taking positions in winners over here, or what you think would be a winner over here, and you want to get some of this money into this account, then you would take a short on this. So as this goes up, you're going to lose money, but it's going to transfer over to here. And then you have the tax write-off associated with that, but you haven't lost a single penny. You've just transferred it into your other account by having what's called a box trade. It's a box trade because you're long and short the same thing, so you cannot lose. You cannot lose when you have a box trade. All it would do is shift money from one account to another account, so you can over contribute early in your career, and then later in your career you could find real stinkers. The next time you hear of a company, you're 2 years away from having to pull this money out, and you hear of a company that bankruptcy is imminent, but it's still trading for $10 a share, and you can actually figure out a way to get a synthetic short in here for the same price that you're not paying for the synthetic short, such that you would make the same amount that you would lose. Why not do it? Find some real stinkers, find some real winners, and just load up on them in your account while taking short positions in your taxable account, and just siphon it over and go ahead and pay that capital gain tax. What is weird is that in Q1 2023, in terms of earnings as well as revenue, discretionary is doing better than staples. I don't know if that's what those charts would be saying, as much as it's saying how it's going to do versus how it did before. In other words, if you had really low EPS the year before and staples had really high EPS the year before, discretionary might do a little bit better this year, staples a little worse, but on an aggregate scale, staples is beating discretionary by a mile. So it's relative versus itself in another period, which may already be too low to begin with. So I don't know if you can read it that way. Do you use options on S&P futures? Not really. No, I haven't really used those at all. No, not really. I used to use them, but I feel if I'm going to use options, I'd rather use them on SPY. that I don't really need to use them on the futures. Regarding your trade on going long ZB and short ES, do you consider certain position size on ZB relative to ES and going so far as using micro S&P? No, I don't use the micro. They carry costs offset one another. Well, that is the benefit of having the two, is that you're going to have positive carry on one and negative carry on the other, because all financial futures, all financial based, all futures that have financial underlyings are in contango. So you will have some carry for any long position. So when you offset it, you can offset the carry. Doing that, I think, is enough. If you can offset the carry, that's enough, because that would mean that the notional underlying is fairly equivalent. Regarding a bull steepener trade where you're playing both the level and the slope, well, the bull steepener, yeah, the steepener trade is the slope, the bull is the level. How do you decide the proportion you would allocate to being long ZB and being long the short mature? Well, for the steepener, there are trades you can make for that. I don't know that I would use ZB in a curve steepener trade, only because it has really high duration. And if you're using the 2-year, it has very low duration. You're going to have to use a lot of futures contracts on the 2-year. So you'll use the 2 to the 10 to get that done. And then you add the 30 for duration. So this is your steepener trade, which is duration neutral. And then you add more duration by using the 30-year, because you can use fewer contracts using the 30-year. Which lowers your transaction cost, right? Is it an overwhelming huge proportion to the level trade and remaining percent to the slope trade? Well, not really. No, I wouldn't say that. This is duration neutral, right? Which means you're long and short. So that means your dollar amount is fairly neutral as well. So it's not as if you have 94% of your money in one trade. It's since you're long and short notional amounts, you're using futures, you're not really, I guess if you look at the notional amount, you got zero and then a whole bunch on ZB, but no, I don't really think about it in those terms. It's mostly what I feel comfortable with and what kind of conviction I have. If I start seeing earnings coming bad over the next couple of weeks and a lot of bleak forecasts and lowered guidance and some weakness showing up in other areas, I may add to ZB or re-enter ZB in hopes that and you got to think about it in the cold light of reason, in hopes that we have a recession. As an individual person, I don't really hope that we have a recession, but in hopes of a recession as an investor, then that is the trade that would pay off. Okay, I'm curious as to why the Fed does not start using its QT tool more aggressively, given that rate hikes and talking tough tools seem not working anymore for keeping financial conditions restricted. Am I right to say that based on history, you must expect a recession after the yield, and then there's just few dots. Usually, if there's more, there's something that says read more, and you click on read more and something falls down, but there was no read more. Same with this one, it had dots, so I was clicking to see if it would open up, and it doesn't. So I guess I'm just expected to finish the sentence and say, okay, I get the thought, I should be able to finish the sentence. We must expect a recession. Based on history, empirically, yes. That every time the 3s to 10s have inverted, the deeper the inversion and the longer it was there has always been a recession, 100%. Whenever the leading indicator index has gotten down to this level, there has always been a recession, 100%. So there are many indicators that have a 100% track record. They're saying that are saying there's going to be a recession based on these indexes. Why doesn't it use its QT tools more aggressively? I think it understands that dislocations in the equity market and negative sentiment in the equity market don't really have that much of an effect on the real economy. but negative sentiment in the credit market does. So they're probably less willing to mess around too much with the credit market by increasing its QT. Right now, no one's really paying attention to that, but it is restricting the money supply, so it is having some effect. But I don't think they would. I think they'll use their tools that they currently have, such as their open mouth operations and their open market operations, to get the job done without necessarily having to increase QT. Here's a theoretical question. Imagine on the one hand that the earnings from most companies this quarter come out positive. Well, they will be positive. Labor market positive, but not, lower, but positive. Labor market remains tight and inflation continues its way down. Okay. On the other hand, Fed stays strong on their narrative of higher for longer and QT presses on. Which side will win in this tug of war scenario? The Fed will win. Whatever the Fed wants to do, the Fed will win. Period. So if you think that the Fed continuing what it's going to do is going to have a certain type of outcome that the market doesn't want, oh well, the Fed is going to win. The Fed's just going to win. Which is going to be, I don't want to say bullish or bearish, because we really have four positions in the market. You can be bullish and you can be not bullish. That does not mean you're bearish. It just means you're not bullish. So you could say, we're going up, or you could say, we're not going up. We can go sideways, we can go slightly down, but I don't think, here's a line. I just can't see us getting above that. That means you're not bullish. It doesn't necessarily mean you're bearish. And again, you can be bearish and you can be not bearish. I am in the zone between, I'd say 3850 to 4,000 of being not bullish and not bearish. I'm just neither. I'm kind of neutral, thinking that's probably a good place to hang out. For now. Can you show how to calculate a 20-day short straddle and why that information is useful to know? Because it's just relative. It's not that it's useful to know. It's just relative to know. So that if I'm looking at generating income, you need some underlying on which to generate income on. So you can use options for income, but you got to have some underlying that you're using, and there's some characteristics or qualities of the underlying that you would like to have. Dollar for dollar, I'd rather make more money than less money. However, the more implied volatility, the more underlying volatility, the more likely you are to either breach your call or your put price unless you're comfortable holding the underlying. So I want to find companies that, I don't mind holding the underlying. And since I already have shares, I don't mind them being called away. So take DHI, for example. When DHI was sitting around 92, I sold a 90 straddle. You get $10 for the 90 straddle, which means if it got to 102, it gets called away from me. Well, it'll be called away from me at anything over 90, but I got paid $10 for it, so it's the same as selling it for 102. And since it's a 90 straddle, it means I'd be picking up more at $80, of which I would do. So at 102, being that it has an all-time high of 109, do I see 2023 being the year where DHI, a home builder, goes on to make 52-week highs higher and higher and higher? I just can't see that. So I don't mind at 102 if it gets called away from me, and I don't mind buying more at 80. So it's an underlying that I find desirable, that has high enough implied volatility that gives me a chance to actually make some money on it. And how do I calculate the 20-day short straddle? You find 20-day options. So on an index like the SPY, you have options. Well, that's on an index. It's an ETF on an index. You have options that expire every 2 days. So just look across the tabs on your options trader till you see the 20-day tab and click on that and calculate the price of the straddle. If you don't, let's say that you only have 28-day options. Because it's such a short period of time, you can, between 20 and 28, you can get a fairly close linear approximation. Do a 28-day short straddle, whatever the cost is, divide it by 28 and multiply it by 20. Divide it by 28 days to get a daily price, then just multiply it by 20. It's a close enough linear approximation that you don't have to worry about the convexity adjustment. I'm surprised to see you are not exploiting low volatility to build into bullish positions by buying call options. Any particular reason? Well, because I'm long a whole bunch of stocks that are going up. I don't need more of that stuff because I don't really believe that there is a significant upside to this market at this point in time. But I am exploiting low volatility. I did it today. I bought 398 puts for March expiration. 398 puts, and this is how I'm going to play it. If the market rallies, I am going to, whatever these puts cost me, I'm going to take half that amount and I'm going to sell calls up here, higher up, around 420, 425 if there's a rally. If it really sells off, great. If it sells off significantly enough, I may try to get dollar neutral by going, seeing where I could sell puts for the same price I sold these puts. This way here, I'd have a spread and no risk at that point because now I'm dollar neutral. I may do that for the other 50% of the value. So by buying the puts, I now wait to see which way the market's going to go, and then I'll determine what I want to do. 2 questions, and hope to hear your comments. Number 1, right now, it is interesting that the market is running in front of the Fed because high probability of recession caused by rapidly increasing interest. What could the Fed do at the point? Again, their mandate is inflation and employment, not fighting the market. Well, that's exactly it. Their mandate is inflation and employment is checked. Inflation is the real thing that they're fighting. Now, inflation is coming down, but they're saying, well, hang on a second, though. Employment is so close to the line. The market is so tight that if we back off and let demand increase at all, it could. Inflation just could come right back. So until we see slack in the labor market, we don't know if we're done with inflation. So I think there's not much Fed could do given the current economic situation. Well, they just can keep raising rates and talking tough. Japan has lost 20 years due to low growth rate. What if that happens in Canada and the U.S.? What asset and investment strategy would you recommend? Well, when we say that Japan has lost 20 years, who was a 20-year investor, right? You sort of have to ask who bought and held for 20 years. There's lots you can do if you are active, if you can generate income with options, if you can find those pockets of winners that will naturally happen in every market, if you know how to play momentum and how to capitalize on momentum. So there's a lot you can do from an active position, but on a passive scale, if you're going to buy and hold for 20 years and there's the possibility that growth could be so low for that period of time that returns would be negative or insignificant, yeah, on a passive basis, sure. But just because, you can say, well, in a bear market, you can still make money if you position yourself right, if you take advantage of falling prices. So just because a market is not going up does not mean that you cannot do well. In the last Q&A, you answered a question about your personal portfolio in 2022, and the simple version was it delivered an absolute positive return ex GM, but a negative return, and I guess somewhat significant negative. Yes, it was. I think you said in the past your rule for maximum position is 3 to 5. Did you stick to your rules relating to position sizing with GM? No, I did not. That's why you get into trouble. I did not, because I just didn't buy into it had such a low multiple, and it was selling every car it could make, and it had already reiterated its guidance and even raised its guidance, but still just kept dropping. The market just didn't believe it at all. That was the problem. And my puts kept being put to me, and I said, okay, I'll just buy more till it just got to the point where, okay, enough is enough. Did you stick to your rules relating to position sizing? Okay. If so, how did the trade make such a dent in the portfolio? Well, I just told you. If not, why? So, it fell from 67 all the way down to 30, and I held it all the way to 30, and then on the rebound to, the 36 to 40 range, that's when I decided, all right, actually it kind of did that a bit, but it was in that range where I said that's, I don't see it going back into the 45, 50 zone for some time. So, let's just play a trading channel on GM and let's just abandon it. I had made back by the end of the year, based on the loss that I had made back about uh, 45% of the loss. So that if the year were a little bit longer, I probably would have recovered most of it just by trading the channel. So, I did recover more in January. Will I do it again for February? I don't know. I just don't know. Like I said earlier, sometimes you have to know when to leave a relationship, and I don't have to make money the same way I lose money, right? I did recover from it, but uh, you know, you still, no matter how long you do this, you'll still learn lessons. And the lesson was cheap stocks can keep getting cheaper. But what really is most upsetting about this is it was because I broke my own rule. I kept accumulating more and more, thinking that, well, come on. I mean, how cheap can it possibly get? How cheap can it get? If it continues on, it'll be free and I'll own 100% of the company. I'll take it. I'll take it. I mean, when it's trading at basically three times its cash flow, uh, how much cheaper can it possibly get? And well, the market says a hell of a lot cheaper. 2310, you suggest that job gains coming from part-time hires is consistent with a slowdown. However, with the labor force numbers recovering from what? Recovering from what? I guess would be my question. Recovering. Isn't it natural that people who were out of the labor force during COVID come back as part-time and then transition to full-time? You mean like instead of jumping in the pool, they dip their toe in the pool until they get comfortable and jump back in? I don't know if that's a thing. Couldn't part-time jobs be interpreted as a good thing? Well, there's are there people who start working part-time to see if they enjoy it, or if they can live with it, and then they work full-time? Sure. But 100% of those job gains came part-time. I don't think that this is such a big thing that it's so universal that everybody does it. I'm pretty sure it has to do with the cost of getting full-time people or the availability of full-time people. If I can't get full-time, well, I'll use part-time for as much as I can, or if I can't afford full-time, nor do I want to afford full-time, I'll hire part-time if I can. That is not a healthy sign when all the job gains come from part-time jobs. And full-time jobs actually dropped. You had actually a drop in them. So, no, I don't know if I would say that. I got 3 questions. Could you please explain in more detail the problems of BOJ with their bond yield, interest rate, and currency rate? Well, quite simply, the yield is just too low given where inflation is. So you have negative real yields. Would you comment on equity residential, which seems to be a high quality apartment REIT but has just performed poorly? Well, I don't really know too much about that particular REIT, but if you have a good apartment building, and let's put some windows in here, and let's put a nice big door, and we'll put some balconies over here and some beer cans at the bottom because, well, that's what happens, right? If you have a high quality building that is like 99% leased and your rents are 16% above market rents, and you have no turnover, everyone's just staying, and you've got super high quality rents in terms of their credit score, quarter over quarter, where are you going? Where can you possibly go? You're pretty much leased up, so you're not going to get any extra revenue out of leasing more. You're already above market rents to begin with. You're not getting any turnover from the tenants that you have, so you can't turn over apartments and remodel apartments to try to get higher rents out of them. Where are you going to go? So once apartment buildings are fully leased up and they're charging market rents, there's really no place to go other than sideways. So it could be that they're performing poorly because they've done so well, there's no place left to go. Are there ETFs for currency pairs? I don't know. No, I don't know. I'm curious about the Refinitiv data you're reviewing at the end of the video. Which product of theirs is this? This is called This Week in Earnings. And if you look down in the description box, there is a link to it. It's free. Okay, what are your thoughts on buying January 2025 TLT calls instead of 2024? Seems like a decent idea to me, seeing as it just gives me even more time for everything to play out. So if you look at the 110s on the calls, you're going out a whole extra year as well, right? And remember that the calls will be centered around the forward price, and the forward price continues to increase. So going out an extra year means that the calls are centered around a different price. So you're going to have different gammas. You're going to have different deltas and different gammas, which means if the 2024 calls move up by 30 cents, the 2025s might only move up by 10 cents or 15 cents and might have a smaller gamma, which means their delta changes at a slower rate. They'll also have a much lower theta, so you'll have significantly less decay over time. But if you don't believe too much in 2023 to tie up money just to bet on what's going to happen in 2024, why not just wait a year and buy them cheaper? If you expect it not to move over the course of the year, just wait a year and buy them cheaper. But it's not as if they're double the price. So, I mean, you can go ahead and buy them. I just find that if you're going out that far, then you really haven't got the kind of conviction in it that would justify you doing that trade. You don't have to have the same belief that I do. You can say, you know what? The guy says this year, I don't think so. I think he's wrong. Well, you could be. And to protect myself from being wrong, I am, over the year, going to get dollar neutral on that trade, which means that sometime by hopefully June, July, August, sometime in that period, I will be dollar neutral, which means I'll hold the calls. They will have been free. I will have recovered every dollar I spent for them. So basically, I'm holding lottery tickets that I got as a gift for Christmas. If they pay off, great. If they don't, I got them free anyways. And then if it doesn't work out and I think, okay, well, 2024 is the year, well, then I'll do it again. That's fine. It's not a big deal. Do you always get money neutral on your trades? Well, not really. If I'm buying options, because there is the very real possibility if you're wrong, you lose everything you paid for it because they expire worthless. They expire at zero. If I'm buying options, I do look for opportunities to get dollar neutral if the market gives it to me. So I bought the 398 puts today on SPY. For expiration in March. I think it was March 17th. I think I paid $10.95 for these. And that's my opening position. It depends on what the market wants to do. I will follow what the market does. Now, I could have, to get dollar neutral on this was the 398s. I could have sold the 379 put and the 414 call for March, and that would have put me dollar neutral right away. However, why should I do that? Why not buy the 1095 puts and wait? And if the market rallies, instead of selling the 414 calls, I might be able to sell the 425 calls instead, or get more money for the 414 calls. So I buy them, and if the move is against me, I can do better on the call. I buy them, and the move is in my favor. I'm already making money. And if I want to, I can sell deeper than 379 put to get dollar neutral. Depending, if we have a good sell-off, I might be able to go to 370 or maybe 365 and sell the put there. So I have my opening position. Then if the market moves in my favor and I start making money, great, I'm making money. Maybe I don't want to get dollar neutral at that point. Maybe I'll just take the return. If you buy them for $10.95, you have a nice sell-off and they go to $19 or $20, that's almost a 100% return on your investment in a short period of time. I'll take it. I won't bother getting dollar neutral at that point. I'll just get dollar rich. But if it moves against me, then yeah, at that point I'd say, okay, well, let's take this chance to get dollar neutral at a better price than I would have gotten had I put it on day one. So I do look at that and I think, how can I get dollar neutral? Why does a lot of economic data come out with the actual and the revised number at the same time? I've already answered this. It is not at the same time. You have a column called previous, you have a column called estimated, and you have a column called actual. And let's say data is coming out for November. You'll have an actual number versus an expected number, and then you'll have a revision for the previous number. This was October's revision. So when you get the release for a particular month, you'll also get the revisions for the previous release that was put out. Okay, how would you manually construct an S&P 500 covered call if you use the same strategy as some of the main covered call ETFs, which would be 1x call on ES futures while selling at the monthly ES calls? Well, you do the same thing. It's just that this is 50 times the index, right? Whereas SPY is 1/10 the index. So you just buy. If you want to replicate one futures, one ES, buy 500 shares of SPY and sell an at the money call. That is one way. Other ETFs that do this will use a 30 delta call to minimize the amount of times it's called away. In bear markets, they probably move it to a 50 delta call. Maybe they back tested it in bear markets and find that 50 deltas you can get more aggressive and not have it called away any more often than you would with a 30 delta in a bull market. I don't know. You mentioned buying a call far out in time to get into a position. Then if the price went in your favor, selling some calls, or if the price went against you, selling some puts to get back some of the premium, gain cash neutral. However, what would happen if the price was flat or sideways with little volatility and went nowhere for all the time you were in the trade? That's called risk, right? For whatever trade and trade plan you have, there'll always be risk. If you could devise something that had no risk, there would be no premiums in this trade because everyone would be doing it because it'd be like, hey, check this out, it's risk-free. That is a risk. How would you manage that position and get cash neutral? Because surely you would be stuck and the initial call option value would simply evaporate. Well, it could. But even if it traded within a range, there'd be some premium on the options. There'd be some range that I would be aware of because I'd be watching and say, well, it seems to be in this tight trading range. So let me take advantage of it, and I would take advantage of that tight trading range, whether I would, buy TLT or, sell puts on it saying, well, instead of buying it, let me sell some puts. Maybe I'd, if it trades in a range like this, I would change strategies so that instead of getting down here and selling puts, so let's say that this was 106 and this was 102. So every time I got down to 102 and sell it, instead of selling 102 puts, I may sell 106 puts so that by the time it gets up here, it's the same as making the difference. I might just switch. So for channel trading, people say, well, you should buy here and sell here, buy here and sell here. And I think, well, no, if you have a channel trade and it's at the bottom of the channel, sell your put up here. If you expect it to do that, just sell an in the money put and you make the money on the way up as opposed to a smaller premium on the way down. It depends on how it's moving, why it's moving, what are the major risk factors in front of us. It's a constellation of things that help you decide that, well, I'm willing to take on more risk to get dollar neutral at this point. Could you please compare the usage of a covered short straddle against two short puts? The two short puts would be the outcome if it were put to you. It's the same thing. So if I buy, let's say, we'll use, what can I use as a good example on this one? Let's just say any stock. You buy it at $100 and you put the short straddle on. So you have a short put and you have a short call. If it works against you and the stock is put to you, it is the same thing as if you had started with being short two puts. It's the same thing. What this allows me to do when I have these, especially if the premium is high enough, it means there's volatility. So if there's volatility, I have a lot of things I can do. As it starts falling, I can take profit on the call or roll the call down. As it starts increasing above this, I could take profit on the put or roll the put up. So I find that I can be a little bit more active in managing the type of income that I make and when I make it. I've done the two put thing before, saying, well, I know it's equivalent to two puts, so why not just sell the two puts? And if it's going to be put to me, I'm in the same position. If it's going to be put to me, but what I'm going to give up is a lot of the potential that I could do on the volatility. Now I do these things. Usually, I'll do these things on things I don't mind owning. I did it on Tesla only because the short straddle was like 20% of the price. And super liquid options, all with, and its volatility term structure looks like that, which means the further out you go, if you roll down and forward, you're actually getting higher implied volatility. So working a price down makes a lot of sense. Another interesting way that it could have been played, if you're looking at something like this so that you have significant downside protection, is, well, right now I'm winning. Tesla's 132. So, I mean, the higher it goes, the lower my deltas go. So at some point, I'm going to take profit on the put. Why not? Why wouldn't I? And I will take profit on the put before they report earnings on the 25th, because on the 25th is a huge risk event. That's when you get to see how ugly those margins are going to be and what they're going to have to give guidance going forward with these new prices they have. So I think Tesla at that point could take a hit. Why not close the put? But what you could have done on Tesla as well is you buy at 125. There's the stock. You'll sell a put at 125, or you'll buy a put at 125. Then you can go down to like $90, and you can sell a put down here, and you can go up to maybe 140, and you can buy a call, and it might cost you. You're still gonna have to pay money, but it might only cost you about $3 to get that done. So that if it drops, your break-even price drops to $93. You basically don't lose a single penny, all the way down to $93. But if it goes up, you have 15 minus 3. You can make $12 on the upside, but you don't lose a single penny until it hits 93. $93 above your lower price. So you could have constructed a trade that way. It depends on what it is you're trying to get done, how you feel, where you feel like playing them, and that's all. There are lots of ways on the initial trade to construct a trade where initially you've got the same deltas on all of them. However, they'll have different pathways depending on what you have. So even if you start with the same deltas, their convexity will give them different pathways. Okay, why you net long SPY? While having the view that it will drop to 31, 36 in either a low growth or recessionary environment. I'm not that net long. I have shares of SPY at 383. I have since sold calls on them, which expire Friday. They will be called away from me, but I got nine and change on selling the calls. So if they're not called away from me, oh well, I make an extra $9 on the shares and I'll sell calls again on them. It's just part of a bigger trade. Now, I don't have a view that it'll drop to 31 to 36. It's not that I'm saying, oh, that's where we're going. I'm saying based on where we are right now and the information that is available now, it appears that this is in the realm of possibility. You could have a significant influx. Congress could get its act together in 2 days and say, okay, we're going to admit 2 million immigrants as long as they have these qualifications. Do they have qualifications in home building? Do they have qualification in engineering and this and that? And they could suddenly admit 2 million people, and 2 million people into the workforce would do a hell of a lot to reduce a lot of those job openings and introduce slacking in the labor market. Something could change tomorrow. But given where we are right now, 31 to 36 is in the range of plausibility and possibility. But that does not mean I'm going to take a short position and ride it all the way down to 3,600, because things just don't go in one direction. You could get there in a number of different pathways, right? You could sell off, have a rally, sell off, have a rally, sell off. Like, there's a whole bunch of ways to get there. So until this volatility is over and this uncertainty is over, because you can talk to a group of people and, oh, we're going down, there is no soft landing. You talk to another group of people saying we're in the beginning of a new bull market run. I mean, it's kind of evenly split now, it seems. So why are you long Tesla despite your bearish fundamental thesis? Because things don't go straight down. I mean, it went all the way down to the point where I thought, okay, it's due for some kind of bounce at this point in time, but I don't want to have the risk of the underlying, so I'm going to use my typical playbook, and I'm going to put options on here. So as it has this volatility, take profit, take profit, take profit, take profit, roll those options, try to get the underlying for free. Is your trading thesis that you will be able to play the options that you can earn enough premiums through option selling to outweigh the declining medium and long-term fundamentals? Yep, that is. A bit more of the big picture question. How is it possible for the stock market to significantly outperform GDP growth over long periods of time? Through something called leverage. Companies have operating leverage, right? So if you have operating leverage, you basically magnify your returns. Operating leverage means that if revenues go up 5%, your operating profit can go up 10%. Because of the leverage that you have built into the system. And then if you add financial leverage to that by using, as soon as you introduce debt into your capital structure, you have financial leverage. Now you have your total leverage is your operating leverage times your financial leverage. So because of leverage, the stock market will outperform on the upside and sell off harder than GDP ever drops. You have a lot more volatility. Well, that's what leverage does, is it magnifies your losses and it magnifies your gains. You have to start a podcast that would be a decent education finance podcast. Isn't that what this is? I don't know. You mean a podcast like that you listen to? It wouldn't work well for me because most of my market outlook is visual. Their charts, their numbers, their graphs, their tables with the rates in them that you can see. If it were podcast and audio only, I would spend so much time describing a chart. Basically it would be nonsense to even begin with charts. Charts don't work well on radio or audio only podcast. But this is in essence a podcast. How long could low growth environment continue before we get a potential recession? To flatten the supply curve, a year, 2 years. I get that the other option is persistently low growth. Well, after the tech boom crash of 2000, the market basically drifted downwards for 2.5 years, and you had an extremely low growth environment. And Greenspan kept lowering interest rates to try to spur the economy on, and eventually got all the way to 1%. And it is believed that it was that loosening of monetary policy that created the housing boom that caused the credit crisis of 2008, 2009. So it can go on for a number of years. Okay, regarding the income factory, what is your rule of thumb to choose the right factories? And is a short straddle the main tool or strategy for it? Not really. For an income factory, I have to be comfortable owning it. In other words, I'm good owning it. It'd be nice if it has a good dividend yield as well. Typically value stocks as opposed to growth stocks. Because growth stocks you're buying because of the capital gain. They typically, in environments like this, they suffer badly. In growth environments, they do very well. You don't need to generate income on them because they generate their own income through a capital gain. But a good value stock that, tends to trade in a very tight channel over time or tends to grow slowly over time is a nice target. And you don't have to use the straddle. You can use 30 delta puts and calls. So if the stock is at $50, you might be using the 55s and the 45s if that's where the 0.3 is. The thing is, you're using them every month and you're not getting greedy. If you're using 30 deltas, you use 30 deltas. If you're using 20 deltas, you use 20 deltas. And you just keep following your rule. About your research process for investing in a new sector or country, I want to allocate less than 5% of my portfolio to the Indian market with an ETF. How can I understand the dynamics of this market and make sure that this decision is correct? Well, I don't know that you can make sure the decision is correct. You can make sure the decision is well informed and that you feel good about it, but you'll never know if it's correct. Only the market will tell you if it's correct. No one can ever say, oh, you're wrong, you shouldn't have done that, you're wrong. Well, you're not wrong. You're only wrong if you lose money, right? So only the market can tell you that. Well, if you're going into a whole new market, the first thing you would do at a particular country is say, well, what are the sources of growth? You know, what does this country do? So if you were looking at Canada, for example, and you're saying, I think we're going to have a real tech boom. Well, Canada's just not the place to be. We really don't have big tech companies. We don't have a big tech sector at all. It's just really not the place to be. So have a look up a look at the makeup of the sectors of the economy. So every economy is broken up into a number of sectors. You can look at what the weighting of those sectors are. Canada, for example, it has a significantly higher weights in materials and energy than the US does. But if you want a really heavy weighting in materials, more than Canada, you go to Australia. If you want even heavier in materials, you go to Chile. Or I think Chile or Peru, either one of those two, go over there and you get huge weightings on metals and mining. If you're looking for tech, US is probably where you want to be. Primarily NASDAQ is where you want to be. What are the weightings of the sectors in India? How are they going to grow? What drives growth in that particular country? What does it rely on? What are the makeup? What's the demographic makeup? Is there lots of room for labor growth before you hit inflation? Who are the major trading partners? Is there capital inflows going into the country? So that's where Mexico is. So as for thinking about what market I'd think that would be doing very well over the next decade, I'd probably put a bet on Mexico. So, it's a lot of questions and it never ends. You're always asking questions and you're always learning more and more. About managing the fear of missing out. It's always better not to take a full position, but I'm struggling to do that because of the fear of missing out. I fear that I won't have the chance to complete my position. Maybe I've lost my chance. Well, there isn't just one position. Warren Buffett, he says a lot of things, right? But he said, this is not a baseball game. It's not three strikes and you're out. You can wait for the perfect pitch. And there isn't just one perfect pitch. At any given time, there may be 2, 3, 4 pitches going on. You don't have to take full positions and say, well, each position is 2%. I got 50 positions. I'm done. Well, now you're fully invested and you have no room to do anything. So you don't have to take full positions because you're going to miss out. And if you have a fear of missing out, find other opportunities. There's more than one opportunity going on at any one particular time. About inflation and interest rates. In a high inflation situation, 40 or 50% a year, and lots of supply issues, will raising the interest rate help? No, raising the interest rate won't fix the supply issues. But raising the interest rate will drop demand to fit the supply issues. But, that's never really helpful. If there are supply issues, you have to fix the supply issues. Raising interest rates won't help fix that. About the corporate life cycle for tech companies like Apple, Amazon, and Google, do you think that they will enter decline phase and eventually follow a life cycle rule and return to some normal companies? Yes. But you didn't say when. You said eventually. Yeah, eventually. I think if you could transport to 400 years in the future, they probably might not even exist. Maybe they will. I don't know. But, give them enough time and enough innovation in other areas and new inventions and new technologies being created all the time. If they are not in on that, one technology could destroy them. Apple's iPhone destroyed research in motion. The BlackBerry's dead, and I think you can pretty much blame the iPhone for that one. So what you want to watch for in these companies are product cycle timing. Research in Motion's product cycle was way, way, way too long. Way too long for a technology company. You have to have 6 to 9 month product cycles. Theirs was, I think, 18 months. That's way too long. It's way, way, way too long. They were going to die anyways, just because of that. As of right now, everything these companies do is relevant. But, things change. I can go ahead and say, there will be a day where Facebook is going to be another MySpace. It will be gone. What will replace it? I don't know yet, but it will be gone. There's got to be something better than Facebook. Facebook seems so ancient now. It seems so kind of like, the yellow pages when you had 411.ca or .com, where you could just look online for a phone number. Like, is there anything like a phone book anymore? Does a phone book even exist? Facebook to me seems like the yellow pages, It's like, well, I don't think younger people use it. So as the population dies and as their users die, I think that's about it. I don't know. But I would bet that Facebook would disappear long before Apple or Amazon would. Why the supplementary videos in the Applied series are not uploaded at the same time, or at least a few hours after YouTube videos? Because staff don't work on Sundays. I do. So when I upload the video, I upload it to a holding site. And then it has to go to Amazon where it is then rendered, and then it's put on the site. Well, that requires IT staff to do, and they just don't want to work Sundays for free. I know, I don't get it either. Kids these days, but that's where we are. So unfortunately, it has to wait till Monday when they come into the office, or when they stumble out of bed and walk over to the desk that's up against their wall that's called the office, because they work from home now. In March, April 22, you had a video where you're making the case you don't see a recession coming based on data at the time. And we're also making the case that historically interest rates were higher and people kept buying houses and doing business. Now your two strongest arguments for a recession are tight labor market and high rates. So April and versus January of 23, conditions change. You can't say something and that's it for life. I mean, if that's the case, how far back do you go? If you're held to everything you say and you can never change your mind, every adult male would be a cowboy, a firefighter, or a cop, right? I mean, you change your mind. Now your two strongest arguments for a recession are tight labor market and high rates. At the time in March and April of 2022, it did not look like the central bank had the conviction to bring rates that high. No one was really forecasting 4.5%, 5% at that time. And the thought of inflation being transitory was still a thing, and rates were not high enough yet to really affect very much. Inflation falling and bond yields falling, don't you think that the equity market was efficient in moving higher? Don't you think the equity market was efficient in moving higher? Okay, I see what you're saying here. Because we see inflation falling and we see bond yields falling, which means prices are rising, that the equity market was efficient, that the equity market would have gone up. Yeah, sure. I don't think that's really an issue. I don't know that I had much of an issue with it as it was going up. I wasn't saying, "Oh, come on, why, come on." I wasn't doing any of that stuff. It was, it's going to move between, I think, 38.50 and 4,000 for a while. I'm not saying there's a lot of upside or that the S&P multiple should increase, but that the market reaction during the past few days was not irrational. No, I don't think it was irrational. We are having trouble, at the levels we are right now. Again, today, 400 on the SPY had trouble. The market was weak in the morning. It fought its way back, but it really was flirting with the zero line. There does not seem to be a lot of conviction in the market, which makes sense. At 3,800 with good news, let's move it to 4,000. At 4,000, you got to start thinking, we still have all of these problems, right? Let's see. Also, the GDP seems to be robust in the labor market too. Well, that is the problem, right? We don't know if GDP is robust yet. Based on GDP now, it seems like it would be for the fourth quarter, but we really don't know yet until we get that at the end of the month. All these increase the probability of a soft landing. Yet excess savings are being depleted. Companies are not investing as much as before. The yield curve is inverted, but on this side, Europe has avoided the energy crunch which everyone is afraid of, and China will fully reopen a huge COVID wave that's going on right now, which will solve even more of the supply chain issues. I hear this a lot. China reopening will solve the supply chain issues. China doesn't make semiconductors, so it's not going to solve that supply chain issue. As far as battery material is concerned, China's the big processor of battery material, but not the big producer, not the big miner of battery material. And, there's a shortage there. Those are physical shortages. What supply chain issues are coming out of China that we were concerned about? I don't know. So, if you could point to a specific supply chain issue that, oh, well, thank God that's happening now, things are going to get back to normal. I don't know what it is. Is it car production? Because there's an overproduction of cars in China, so it can't be a supply chain issue there. Right now, they cannot sell every car they make. So I'm not sure what supply chain issues are being solved by China reopening that have not already primarily been solved. In my opinion, the longer some new negative data delays coming, the more the soft landing scenario becomes a possibility. Well, okay. You can have a soft landing, but it's a very narrow window for a soft landing, and it would have to stay at that level for an extended period of time, because as soon as you got to bounce off of that, you'd be pushing right back against labor inflation, because you still have a tight labor market. Not only do you have a tight labor market, you also have aggregate incomes that are decreasing. You have the average work week, which has been decreasing for a couple of months. You have overtime hours, which have been decreasing for a couple of months as well. So if you do have a surge in growth, where are you going to get the workers from? So we still have a big supply issue, which is the labor market. So I'm not really sure what question was in there other than just you seem to identify some bullish things and you seem to identify some bearish things. So I think you are in agreement that it seems to me that you're saying that the higher we go, the more unlikely that you can go higher, and the lower you go, being that there are some bullish things, the more unlikely you'll go lower, which speaks to a trading range. And this was 2003, 2004, 2005. The market was just doing this. Like for 3 years, it was moving within a 500-600 point range, and that's all it did. It had trouble at 10.8 all the time, and then it would sell off, and it would come back to 10.8, and it just wouldn't go anywhere, and it would sell off, and it just did that for a long period of time. I think it was 2003, 2004, maybe not all the way into 2005, but it just went sideways for so long. Everyone thought after a while that we were just going to have a sideways market. Have you thought of the effect of behavioral biases in your analysis? Without any insult, clearly we are all here to learn. I appreciate you immensely. Any behavioral biases? Oh, in my analysis. Do I have any behavioral biases? As I'm doing my revision for CFA Level 3, I'm thinking of the potential of conservatism bias and confirmation bias in your analysis. I don't know. I am at this point insensitive to money. So it doesn't register as money to me. They're just numbers on a screen. So, I don't respond emotionally to winning or losing. Winning used to feel like years and years ago, winning felt great, losing felt bad. Now it's I don't feel anything anymore. And when I am making a bet, I'm very careful in what I do. Is I only want to really make a bet on something that I really feel good about, and then I have the options that I use. As long as I have different strategies I can use to hedge out very quickly if I'm wrong, or to lean into it if I'm right. I don't know that I have a lot of behavioral biases per se. No, sometimes I fall in love with a particular trade that's worked for so long, and I stay with it for too long. Sometimes I have that problem where I just don't leave it soon enough. And then there are times where I think of something new and I think, well, yeah, that's a pretty interesting trade, but I've never done it before. I've never been in that sector, but it's looking good, where I'm too hesitant to go in because I've never done it before. So I may be biased in those particular ways. But I don't know if I have a confirmation bias, because I'll read good and bad news about things. I'm aware of what the good news are. I'm aware of what the bad news is, and but it's hard to say. I will say this: if we're talking, because behavioral biases break down into cognitive and emotional. I have no emotional biases that I'm aware of. I'm almost robotic in my emotionlessness. If something's moving against me, I don't get upset. It's more of a, okay, well, that's interesting, but because I know that I have options to use, so I can always end something very quickly, or hedge out, or all sorts of strategies. As far as information processing biases, once you get enough experience and enough education, you typically know how to avoid all those things. So I'm not saying I don't, but if you could point to something specific saying, aha, here, over here, it looks like a bias. For example, when I did early in the year, I did a video called "The Ice Age is Far From Over," where I said, here's my view on Tesla. It's going down. If you read those comment sections, oh, you're biased. You're biased. Yeah, but I was right. I was not biased. I was informed. I came to an informed opinion, and I felt that Tesla didn't justify its pricing. Its margins were going to disappear. It's not going to get to keep them. Competition is going to come in. And at some point, it's going to trade like a car company, and it's going to have car company margins. And at the end of the year, I said it should be around I forget the price I put on a 414 or something like it. After split, it came to 139. Well, it ended the year below that, so I was right. I wasn't biased, but at the time, people who listened to it said, "Oh, you're not saying the things I believe in. You must be biased." Just because somebody doesn't say the things you agree with doesn't make them biased. It may make them differently informed, but not biased. So if you can say, well, what about this over here when you did this and said that? Wasn't there some bias in there? Then I can at least address that particular thing. But on net, overall, I don't think I'm biased. I know I can tell you flat out, if you stand in the background and watch me, you'll not see a flicker of emotion from making money or losing money. You won't see any emotion. I have become emotionless when it comes to that, so it will only be information processing. You raised a good point about the average hourly earnings slightly ticking up because of increase in part-time workers. Some part-time workers actually get benefits, such as those that work at Costco. Should we account for those who do not? Not sure BLS has part-time workers without benefits. None of the average hourly earnings in the BLS include benefits. If you want the effective benefits, you have to look at the employment cost index, which we'll get on the last day of this month. Let's see, 2 questions about the labor market participation rate. Have you considered that many companies can outsource a lot of functions outside of the U.S.? Well, that's what offshoring is all about, is that you can outsource all this. So when you have your iPhone assembled in China, that's outsourcing. That is basically what outsourcing is. When you have your IT department in Bangalore, or in what 2 countries in I think it's Argentina and Colombia have really growing IT sectors as well. That's outsourcing. That's exactly what it is. Been going on for a long time. Let's see. One of my clients, 45 employees, half their staff are located outside Canada, mostly in Poland. Yeah, that's right. Growing trend that I've been noticing. So, well, this is the whole idea of reshoring, friendshoring, nearshoring is, yeah, you've outsourced all of these things. Your call center is in India, your IT center is in Azerbaijan, your manufacturing center is in China, and you're having other companies doing it. But because of the supply chain disruptions and the shortage of critical parts, that's that whole concept of let's bring these jobs back. Well, you had to outsource them because you couldn't find the workers. If you're going to start bringing them back, where are you going to find the workers? I mean, they're just going to leave again because you can't find the workers. So this is not anything new. This has been going on for quite some time, and it was the introduction of the World Trade Organization, especially the introduction of China to the WTO, and the fact that almost every country in the world has a capitalist model in place. Other than hardline socialist and communist countries, almost every country has a capitalist model. Well, what else can happen at that point? So outsourcing has been going on since the late 70s. Textiles were the first to leave to South America and to Vietnam. Then throughout the 80s, a lot of manufacturing left because you didn't need to get all your parts, in one place, and eventually, more and more jobs started leaving. So I don't know that somebody's going to wake up and say, "Hey, let's outsource this." Well, that's been going on for a long time. On the automation front, have you given thought to innovation that can render certain jobs obsolete over time? That also has been going on for a very long time. The question is it going to accelerate, and what jobs will be made obsolete? Will it be jobs that are made obsolete in which the workers then are qualified for other jobs? They would have to be qualified for higher skilled jobs because automation usually eliminates repetitive physical and repetitive cognitive work. So robots on automotive lines, that's repetitive physical work, and robots are great at doing repetitive physical work. Repetitive cognitive work, that's where you are doing something that can easily be written in an algorithm and off you go. AI is trying to replace non-repetitive work where decisions have to be made about how you move and what happens next because it's not repetitive enough to be programmed in a simple algorithm. I think we're years and years away from that actually happening. And during that period of time, somebody has to build the robots, somebody has to build the algorithms, right? So you may be replacing workers here, but adding workers there because it creates whole new industries. So yeah, I have, but that kind of stuff moves so slow that it takes time to justify that. However, there was a story out a little while ago, and I said a couple of years ago that this is eventually going to happen, and this was over the minimum wage debate, and California is probably where you're going to see it roll out the fastest. There is a McDonald's, they're testing a McDonald's now that is completely automated. Everything. I think there's one worker, but everything is automated. The whole kitchen. Well, of course, you think about it, you go, well, when you dump those fries down, they're only down for a certain amount of time. It's timed out. Each hamburger, the flip of each hamburger is timed out. Everything is timed out. What do you need a human being doing that for? So if once you start saying, McDonald's workers and fast food workers should be getting $29 an hour, well, you're going to lose them all to automation. Absolutely. But where can they go? They would have to go to a job that requires more skill, because if automation can replace them, it's not as if they could just go to another place that does the same thing. It's only a matter of time before automation eliminates the job category. And if they were only qualified to do that job, you have to ask, where are they going to go? And unless they can go to another job, they will simply fall out of the labor force, thereby constraining the participation rate even more. Let's see, if you had to have a different career path in finance to the one you've had so far, what would be of interest to you? Central banker? No. I certainly wouldn't. I don't know that I would do a public service job. They don't get paid that much, by the way. I mean, you make a hell of a lot more if you're in private business. But then again, after your career as a central banker, you're on easy street, sitting on boards of directors, getting paid $150, $250 a year. You could sit on 5 or 6 boards, write a book, do speaking tours. That's the big payout, right? Stock picker, well, kind of am that now, right? Private equity GP, well, when you start your own business and you build your own business, it is private equity. CFO, well, I've worn all those hats, in what I do. What would I want to do full time? I would not want to be a CFO. Not for a company. I don't think I'd want to do that. It doesn't sound exciting to me. It sounds very bureaucratic, very structured and rigid, and it just doesn't seem exciting and interesting to me, because it just doesn't. I don't see where the excitement is. If I were going to be in a business again, I'd have to be the leader, to grow it, to be the dreamer, not the implementer. Private equity general partner. I don't know. I don't know that there's enough excitement again in there. I'd miss the markets because of everything going on and the lights flashing and this information and that, and it's just a better chess game to play, I think, as opposed to private equity GP. So I'd probably say, well, stock picker is where I'd want to be. Actually, here's the thing. I'm right where I want to be. I got my foot in all of the worlds that excite me. I love teaching and I love education and I love learning. I've never left the university system ever since I entered it. I spent how many years on one side of the desk as a student getting 5 different degrees, 2 graduate degrees, and then how many years on the other side as a professor. And, I still consider myself an educator. But I felt the draw of the market rather early, because if you have a mind that can spot opportunity, you can either create your own businesses again and again, or you could just look in the market and say, where's opportunity? Because it's everywhere. And I have been the entrepreneur because I have built a good, successful business that I then sold to a private equity funded company. So I think I'm right where I want to be. But here's the thing. If you do something in your life that gives you meaning, you will, at almost every point along the way, be exactly where you want to be. So look for meaning, as opposed to, what career do I want? What would I do? Follow the meaning. Whatever gives you meaning, that's what you want to do. People say, do what makes you happy. No, don't do what makes you happy, because you're not going to be happy all the time. Happiness is not a state of mind that exists permanently. Happiness is a feeling you get that eventually you find an equilibrium with, and you no longer have the happy. If you find meaning is what stays around even when you're unhappy. Let's see. I was wondering if at any point you'd done a walkthrough video explaining some of the content discussed on those weekly recaps. That's kind of what these Q&A videos are, right? I think it would be tremendously beneficial to the channel if there were one video to kind of ramp up on some of these concepts so that digesting all the content you unpack on a weekly basis is easier. So these are the market outlooks are part of what I refer to as an applied series. It's very applied to the market. My primary audience are CFA candidates and CFA charter holders as well. I have some charter holders that watch it saying good ideas. If you're going to watch it for a source of ideas, great. But it's really for the primary market is CFA candidates, so they can see in these videos all the concepts that they are going to learn through level 1, level 2, level 3 that are applied to the market. We start off with par rates, and we look at real rates, break-even rates. Well, level 1, you're going to be introduced to par rates, spot rates, forward rates. Level 3, you're going to see Fed fund futures, capital market expectations. You're going to see a lot of fixed income yield curve strategies. So we looked at a yield curve steepener, adding duration. All of these things are applied. So, as far as doing a video to explain some of these things, that is what level 1, level 2, level 3 of CFA is it does do that. But in every video, every market outlook I put up, I try to take one concept that I explain a little bit more. So in this last one, I explained, the idea of the labor market and the steepness of the supply curve in the labor market now, so that if you are familiar with supply and demand dynamics, you know that we can solve the problem not necessarily by shifting the supply curve, but you can solve the problem by flattening that supply curve, such that if you do get an increase in employment, it is a much smaller increase in wages. You can avoid a lot of the wage inflation, but the supply curve is far too steep right now. So I do take time to expand on that. But if you are a CFA candidate, as you're going through level 1, 2, 3, you'll start to recognize more and more and more of this stuff. Let's see. So I guess we should look at equity in automation. Any kind of productivity solution, online working solutions to get in foreigners, and solutions for people who need to have 2 jobs because they can't afford to pay their rent anymore. Anything that could be a quick fix to the tight labor market. Maybe automate the 1.5 million truckers in the U.S. and get them to do other jobs, for example, or 3 million cashiers. Well, that is the thing, right? If you automate the trucking industry and these truckers leave, can they do other things? Because if you are taking away all the jobs that require the least amount of skill for, now, sure, you have to have a license to drive a truck, and a trucker will say, oh, you got to have a lot of skill, but a cashier will say, oh, it's not as easy as you think. You need a lot of skill. Everybody thinks their job is not as easy as you think because they put up with a lot. The guy who drives on the back of the truck here once a week and picks up my garbage thinks that it's not as easy as you think. No, it's not as desirable, but no one thinks it's easy. But nobody wants those jobs. Nobody wants them. You end up in them, right? Can you get them to do other things? Same with 3 million cashiers. Nobody aspires to be a cashier. It's for lack of alternatives. It's for lack of options. It's not as if you're sitting around saying, first year law at this big law firm or cashier. God, the decisions. I mean, no one's making choices like that. No one is tossing up 2 jobs and saying, hey, you know what, cashier, I'm a people person. You end up there. So can you actually release them from their job and they would go somewhere else in the economy? If the answer is yes, then automation is a benefit for the economy. If the answer is no and they simply leave the labor force, you don't actually fix anything, and you've actually lowered aggregate demand and aggregate incomes. It is actually a negative, what Schumpeter called creative destruction. I want to confirm my understanding that we short ES June contract at 40.50. And SPX is, I don't think that was right, but let's just use your example. You're going to sell an ES June contract at 40.50. If SPX is at 39.50, that means that we would have a 5,000 positive roll. And even if SPX ends at 39.50, we get to keep the 1,000. No, you get to keep the 5,000 positive roll. Yeah, you do. You get to keep all the return. You were short at 40.50, and on expiration date, you get paid the difference between where the price is and where the index is. Because on expiration date, they have to converge. Those prices have to converge because the forward price is equal to the spot price multiplied by E, R minus Q to the T. T is 0, which means this whole term is 0, which means forward equals S. So they converge, and if the spot price is at 39.50, that doesn't change the fact that the forward price is at 40.50. So you make 5,000 bucks, and then you do a decomposition analysis. And a decomposition analysis says what is the source of your return. And so you break down the source of your return. You could say, well, 100% of my return was the roll return. So it was, well, you were short a market to get a roll return. You probably, and since that was just a function of an interest rate in time, you could have gotten that another way. You could have gotten the interest rate in time in another way. So you really didn't make anything, did you? That you want to make sure that, when you do a decomposition, a significant part of your return is going to be from being right that the market went down, your short position played out. However, the steeper, I shouldn't say the steeper, the higher interest rates are, like if you have high short rates, the higher these interest rates are, the better the carry. So if you're going to be short, you can say, hey, I think the market's going down, and you know what? I got a lot of carry. This is great. So you have that cushion in there. But yeah, it's not as if you got to give that back after. The contract price was 40.50, period. That's the contract price. Doesn't matter how that price came to be. That's the end of the question Q&A session.